Hello, I'm Emma Wall, and joining me today to talk about value investing is Jupiter's Ben Whitmore. Hi, Ben.
Good morning.
So what is value investing?
Value investing is hunting for lowly valued companies where the stock market is not that keen on them for a particular reason. The economy might be bad or they're just out of fashion, but where you can, if you like, buy a lot of profits in cash for a low amount.
Value is a type of factor investing, and there has seen a significant divergence in factors between growth and value of late. It's something that we've seen in the past. It happened in the late 90s before the dot-com bubble burst. But the drivers of that divergence, that dichotomy last time around, were significantly different to the drives today, weren't they? What has driven value and growth to perform so differently over the recent years?
Yeah, so you're absolutely right. Value investing has had a very tough period in the last few years. Really, the difference between the late 90s and now is that the late 90s was all around optimism about the internet, whereas now, my sense is it's all around worries. People are so worried about the world, very worried about disruption to industries, very worried about the prospect of a global recession, that actually it's been driven by worry, not optimism. So completely different, but the same divergence between the two styles.
And in the past, whenever there has been a period where value has underperformed growth, it has then bounced back. It's been referred to as an elastic that just gets stretched to a certain point, then it pinged back to normality. What kind of trigger might there be that will allow value investing to come back to that kind of rolling average?
Yeah, so we've looked at the 10 worst periods for value investing in the world over the last 100 years, and this is one of the 10 worst periods. And you're right, when there have been very, very poor periods for value investing, in those other 9 periods, the subsequent 5 years, value as a style has rebounded. Now, we don't know whether it'll be the same this time around, of course, but the triggers each time have been different. People still not quite sure over the triggers in the late 1990s, 2000. The triggers in early 1990s and also around the Great Depression going all that way were things getting better. So it tends to be a variety of things, but normally it just has to be a change from the prevailing sentiment. So this time around, for example, the prevailing sentiment is around enormous worries about the global economy and enormous worries about negative interest rates. Something around there probably has to change.
Now, it has been tough, in particular 6 months, February to August this year, for value investing and investors. But presumably, as a professional value investor, this creates opportunities for you because you are looking for good value and there is value out there.
Yeah, you, as ever, during a tough period of value investing, you're partly thinking about I hope it doesn't get any worse anymore, but you're absolutely right. On the other hand, you're thinking when you're feeling a bit more optimistic, hopefully these are the seeds, these investments are the seeds of much better returns over the subsequent period because I'm able to buy shares at such low valuations. But as ever with things is when you're out of favour, you're a tightrope between nervousness and optimism.
And there is, of course, that difficulty with value investing, which you learn to avoid over time. What is a good value stock and what is a value trap? Perhaps you could explain a little bit more about what a value trap is and how to avoid it.
Yeah, so value traps are businesses where they're lowly valued, but things carry on going wrong. The profits don't recover, they fall away, or the business needs to make a big acquisition to shore it up, and actually your undervaluation is just not there, and in the worst case it's you've actually paid too much for that business. So the areas we look at to try and avoid these are, we want businesses where there's a reasonable quality of business. We're not trying to pick up businesses which are poor, low margins, struggling. We don't want to take a chance with the balance sheet. We want to make sure they turn profits into cash. And by doing that, you try and eliminate quite a few things. You will never, I'm afraid, eliminate all things. That's impossible. You know, the fund manager who thinks they'll get 100% right is delusional. But we're trying to sort of eliminate the chances of us having too many problems. A lot of the times people always think about the upside. I think our starting point is the downside. You know, what are the things that could go wrong? And then just a more sort of common sense thought about the business. Is it likely to be around, 10, 15, 20 years time? And if you do have like a question mark about that, that's probably something you shouldn't touch. But if without a shadow of a doubt you think it's definitely going to be around in 20 years time, then probably that's quite a good indicator.
Ben, thank you very much.
Thank you.